Good afternoon, everyone. Thank you for joining us at our webinar today, where we're going to take an outlook of the affordable debt and LIHTC equity markets. I'm Monty Childs. I'm a Senior Vice President of Business Development at Cinnaire. And by the way, we are recording this, and we will make a link to the recording available after the webinar. So if you want to forward it on to your colleagues or simply review it yourself, that will be possible. Um, we'll have four panelists today. I'll be introducing them individually. And during the presentations, if you want to pose any questions, you can do it through the chat box, but we'll be taking all the questions at the end, and hopefully we'll be able to get to as many as possible. Our goal today is to provide some helpful insight on what is a challenging environment in our world. So let's get right into it. I'd like to first introduce Ben Stahauer. Ben is Senior Vice President of Business Development at Cinnaire, and Ben will kick us off with an overview of the debt and equity markets.
Yeah, thanks, Monty. We're at an interesting time for the equity market. Equity, when I speak of it as specifically low-income housing tax credit equity, we've been a syndicator for over 30 years. There's been times where certainly the market there's been high demand for the tax credit, lower demand for the tax credit. We're at a time right now where there is demand for tax credits. We have investors. 2025 was the largest year of investment in the low-income housing tax credit industry, with over $25 billion invested nationwide. However, the supply of deals right now remains well in advance of the amount of equity in the market. So what we have is an imbalance of supply and demand. We've seen this coming for some time, where there's just a lot of deals in the market, a lot of large 4% deals take up quite a good volume of the market nationwide, far more than before. And we're at a place where we've been able to manage this for some time, but we now find ourselves in a place where yields have had to climb significantly in order to attract new investors to the market to really clear the product that we have. And we're still hopeful that it can clear. There are more deals in the market now than likely can get done. So as a result of that, a year ago, I was just at a conference in Michigan, the Michigan Building Michigan Communities Conference, and a year ago, we spoke about the idea of pricing being in the 70s on deals that are economic. So when I talk about yields climbing significantly, I'm talking more of economic deals and not as much CRA deals. CRA deals being in large metro markets where there's more CRA demand tied to them because of benefits for investors and requirements they have there. So for the non-CRA, the more economic deals, we talked about pricing in the 70s, and we thought that sounded crazy because we haven't in the last 10 to 15 years had pricing in the 70s. That's not been a thing. And we are now at a place that I think, for a lot of economic deals, we're at low 70s to mid 70s. I think 75 cents would be a price that would work for many people that they would move forward with if we can provide it. So I think we are at a place where there is still oversupply, and it's going to be a good amount of time, I think, until that clears. We have a lot of proprietary funds, and direct investors are full for the year or close to it. A lot of multi-investor funds, ours included, is full for the spring. Once we close that, we can start looking at new deals, but it certainly continues to be a challenge as far as pricing. CRA markets will still price better, of course. There is still those markets that have a high demand where we'll find pricing that's more in the 80s, and then on the coast, in the 90s. But for non-CRA, it continues to be challenging. I think there are some things that are happening in the market. I can touch on this a little bit later about, the outlook and how we can get deals done. Um, but right now it remains a challenge on the equity side. Another thing I'd like to just talk through is that Caitlin Kretz will talk about this in a minute further, but There is flight to quality. I mean, there's investors want really high quality deals. If we have, because there's an oversupply in the market, if there's a deal that is not as strong as does not have all of its sources completely committed, doesn't have strong financial guarantors, it's much easier to move on from that deal because there are so many, and that's a reality. There are new underwriting guidelines from AHIC, the Affordable Housing Investor Council, that they really set the tone of the market for investors and syndicators as far as underwriting guidelines. And these guidelines have been updated, particularly regarding guarantor strength and real estate owned schedules. So that's the developer's portfolio strength and their balance sheet. We've seen a lot of stress on that recently, which has been, a point of concern and some heartburn for investors. So they have updated guidelines to make that a little bit more strict, require more of developers on the balance sheets, and a more in-depth look at their REO schedule. With that, I will turn it over to Caitlin Kretz. She's going to touch on the underwriting, so I just kind of introduced that a bit, but I'll send it over to Caitlin.
And Caitlin Kretz, thank you, Ben. Caitlin Kretz is Cinnaire's Senior Vice President of Equity Underwriting, and Caitlin is going to be addressing the current underwriting guidelines that we're facing. Caitlin?
Thanks, Monty. Thank you, Ben. Just to really extend what Ben's remarks were there, given the supply and demand market today, investors are having to be even more selective of the deals that advance and ultimately are secured in these equity funds. And so, with the latest guidelines that AHIC released, developers should be aware of the additional scrutiny and rigor that syndicators are going to be applying to each project when they have the opportunity to dig in further. What this really will mean for developers who are looking for a commitment is to be prepared to show more than you tell, and that means having your 3 years of audited financial statements. It's having tax returns. It's having an up-to-date real estate owned schedule. One thing that Ben referenced was that universally we're seeing partners who have had distressed or challenged properties on their real estate owned schedules, and the developers that have the ability to tell the story behind that, and as well as to provide data to defend what has contributed to those challenges. It's important to delineate that portfolio-wide challenges are not necessarily a result of poor management and ownership or oversight, but rather to be able to point and paint a story that makes it clear that this is a unique challenge to that property or to that market or within that county. But it is not a satisfactory answer to say that it's been a hard year and we're overcoming it. There's a lot more data that's needed to defend a sponsor's real estate owned schedule. And related to that is obviously the effect or the consequence to property or to the project level financial statements that ultimately reflect the performance and success of an owner's portfolio. AHIC, what I'll point to that's most notable of these released guidelines is that they're moving away from a fixed 1 million liquidity, 5 million net worth, and have identified that those threshold requirements no longer satisfy the market that we're in today. It's worth mentioning that the size of deals today is materially different than the size of deals 5 to 10 years ago. We're seeing more and more deals in the 10 to $20 million range than we have seen in years past. And so the minimum thresholds that AHIC had previously advised really do not necessarily satisfy the risk that those larger projects can bear. And so AHIC has advised that investors and that syndicators take a closer look at the project level risk and right size the liquidity and net worth requirements based on the unique risk of the deal. So that means that syndicators are having to look at the developer fee pay-ins and holdback amounts. They're looking at the amount of sources that are secured versus the sources that are pending. They're looking at the balance sheet and the stability of the guarantor year over year. So not just a point in time balance sheet, but how has that balance sheet evolved over the last 3 years, and how does it look today? And most importantly, related to that balance sheet is the contingent liabilities. There are a lot of developers who've successfully closed deals, but deals that are not yet stabilized still pose a great risk to any, sponsor's balance sheet. And so investors today are weighing that risk more materially than they may have in years past. And then I would also point to the construction liquidity analysis that that AHIC is advising that we continue to calculate and manage for every project. That construction liquidity calculation looks at the hard cost contingency plus developer fee holdback plus guarantor liquidity divided by the hard cost of the project. And AHIC advises that for new construction projects, there's 15% liquidity or 15% construction liquidity and 25% without including the guarantor's liquidity. And for rehab projects, they want to see 12%, including the guarantor liquidity, and 20% without. So that calculation has been resurfaced in these new guidelines and have been reinstated as a key metric to demonstrate a project's, strength of their guarantor's liquidity. Aside from the rigorous sponsor analysis that's performed, I would say that there is equal, if not greater, stress test analysis that's expected for every project that is seeking an equity commitment. So these projects, we want to see that these projects can endure any of the following scenarios and probably more that I may fail to mention. So one is construction delays. We have all syndicators have seen the consequences that come from unexpected challenges that may arise during construction. And we have found some agencies becoming less willing to offer tax credit swaps. And so that's putting more and more pressure on projects to meet their place in service deadlines. In addition to construction delays, there's cost overruns that we want every project to have the ability to absorb unexpected changes to the underwritten uses. Interest rates continue to climb or have continued to climb at least this last 6 months. And so for any projects that do not have an interest rate locked or fixed, we want to be sure that that project will have the ability to absorb interest rate changes prior to closing. All of those are examples of the variety of stress tests that every project must be able to demonstrate an ability to overcome. And as Ben spoke to it, the flight to quality, or what I'll call the survival of the fittest, the projects that advance the fastest and the smoothest are the ones that have ample room and cushion to absorb unexpected changes. So with that in mind, I will turn it over back to Monty to introduce our next panelist.
Thank you, Caitlin. And now we have Mark Stay, who is a senior loan portfolio manager at Cinnaire. And Mark is actually coming to us from an airport terminal today. So we appreciate him going above and beyond the call of duty. Mark will be speaking about what Cinnaire does as a CDFI.
Yeah, thanks, Monty. Hopefully you can all hear me well. So like you said, I work for the lending arm of Cinnaire. We are a CDFI. And what CDFIs do is they focus on specific, neighborhood lending that may be passed over by the more traditional lending practices. So I'll start off by talking a little bit about interest rates. Caitlin mentioned them briefly. Fortunately, with CDFIs, we are a little bit shielded with the dips and climbs that the main market is, although not completely immune. I want to point out about 3 years ago, maybe 4 or 5 by now, the secured overnight financing rate was at 0. And then in order to curb inflation, the Fed kept raising the rates, and it jumped up in the course of a year from 0 to about 5.3. Now, because of the way that we borrow funds from other banks, we weren't immune to that. We had to raise our interest rates. What was more challenging for the developers was those who had variable construction loans, who underwrote it, assuming certain rates, and then weren't able to cover gaps that appeared later on because the rates raised so much. The good news is that they've seemed to plateau, at least in comparison to how they were raising up before. And although they are still higher than a lot of us would like to see, they're at least more predictable to underwrite. So the other good news is that the lending money is out there. We haven't had a lot of issues personally, and I haven't heard any developers say that they've personally had issues getting debt. Banks are typically willing to lend out money. The flip side of that is again what our previous panelists talked about is the costs are rising. The cost to do these deals are rising, and we are getting requests that are higher than we've ever seen before for all types of loans, from pre-development loans to bridge loans to permanent loans. And there's going to be a need to use soft debt to close a lot of these deals. So the soft debt that we've seen in the last 5 years or so has come a lot from ARPA money, the American Rescue Plan Act, there to help out during COVID. And a lot of these funds that the cities got were reallocated to housing, which was great. And so we saw a lot of low cost, no cost funds coming in through ARPA to close some of these gaps. That has all but dried up. We're not seeing very many ARPA funds as part of the capital stack anymore. There are other soft funds that we are seeing show up, which is good. However, and these soft sources can come from various places. The Federal Home Loan Bank has, at least in Chicago, has raised their allocation award amount from 1 to 2 million in the last 2 years, which is huge. Along with that comes greater competitiveness. So we're seeing a lot of deals that may have gotten AHP in the past, if they're underwritten earlier, not get it. We're also seeing a lot of private foundation money. The state finance agencies have programs and allocations. They're low cost or no cost. We're also seeing partnerships with businesses and universities. I've seen companies like Amazon show up in the capital stack, Whirlpool show up there, hospital systems. These companies are realizing that housing is a key component to the success of their business, and they're willing to step in and help out how they can. Of course, there's always city funds in a lot of the cities that we work for. The cities are doing their best to focus on affordable housing. Now, with all these soft funds, however, they all have their own ideas of what they want to see in the housing. And so we've seen some deals struggle to make sure that they're covering each of the criteria for each of the soft funds. And that's caused delays, that's caused them to have to reconfigure the targeting, and what they're trying to accomplish with the housing. So that's basically what we're seeing in the market today. A lot of challenges. However, a lot of deals that are written well, that have that good operating performa, we're happy to lend to and help out however we can.
Alrighty, Mark, thank you. And I just wanted to remind all of our audience, if you have any questions, please pose them through the chat box, and we'll get to those at the end. Although, Mark, I'm going to ask you, I'm going to contradict what I just said. Just a couple of brief questions for you. Acronyms. CDFI and AHP, if you could define those.
Absolutely. CDFI is Community Development Financial Institution. And we get our money from a few different places. There's treasury money that is low to no cost to us. We also have corporate lines of credit that we have with bigger banks that allow us to lend to the community. So AHP is Affordable Housing Program. It's an award program that the Federal Home Loan Banks have done for years. And it basically awards money for projects that meet their own criteria for affordability and et cetera.
Mark, thanks very much. Now our next panelist, Leah Horowitz, who is Senior Manager of Originations at Cinnaire's affiliated company, Community Preservation Corporation. And Leah is going to be speaking about the current permanent debt market.
Thanks, Monty. Happy to be here today. So, despite market volatility, the volume of deals that both Freddie and Fannie are seeing remains very high. I spoke with a Freddie affordable representative late last week who mentioned in the affordable products alone, April inflows were over $1 billion per week. Both Fannie and Freddie are highly focused on affordability and profitability this year more than ever, with their top priority being to meet their very low income goals, which is units with rents at 50% AMI or below, and their low income unit goals, which is units with rents at 80% AMI or below. So, in other words, Fannie and Freddie are offering the most competitive pricing and loan structures for deals that have the highest amount of affordability to help them achieve those goals. Similar to what Caitlin and Ben were mentioning about guarantor requirements, Fannie and Freddie are taking a similar approach and requesting very clean sponsor due diligence, specifically for REO schedules. They really want to see complete, up-to-date, and accurate information to analyze at submission, so prior to them reviewing the deal. So we've been very diligent in making sure that all of our I's are dotted and T's are crossed in that. Given the current market environment and challenges in structuring the capital stack, I thought it'd be helpful to highlight one of Freddie Mac's loan products, which is the non-LIHTC preservation rehab product. This product works well for acquisitions for sponsors looking to finance a moderate rehab on an affordable property. So a qualified affordable property would mean that there is a rent and/or income restriction in place at the property, or if the property benefits from a rental assistance program, such as a Section 8 contract. With this product, if the sponsor agrees to invest a minimum of $10,000 a unit in capital improvements, Freddie Mac will fund up to 95% loan to cost, with the calculation of costs inclusive of the capital improvement budget. The first 2 years of the loan will be interest only, and the rehab must be completed with tenants in place. The last point I want to mention is that Freddie Mac has officially retired the Small Balance Loan Program, or SBL program, and revamped the program to now be called Conventional Small Loans, which is for market rate deals between $2 million and $10 million. This is now more aligned to compete with Fannie Mae's small loan program, which is market rate deals up to $9 million. Both agencies will offer the most competitive pricing for this product specifically, with properties that are between 5 to 50 units that offer low income rents. So that's 80% AMI or below. So to sum everything up and reiterate it one last time, the more affordable the deal, the better the pricing and the more attention the deal is going to get at the agencies. Back to you, Monty.
Thanks, Leah. And I think one of the things that you mentioned with the non-LIHTC program, the high amount of leverage, up to 95%, I believe you said. And correct me if I'm wrong, but that's not simply a theoretical program. Cinnaire and CPC have actually closed under that closed a deal or two under that program and were able to get in the 90s leverage, correct?
Yeah, that's correct. We recently closed a deal this year. It's not a well-known product, so that's why I wanted to highlight it because in this scenario, it was really helpful and we were able to get the deal done because of this product that Freddie Mac offers.
All righty. Well, so that's a lot to process from our four panelists. I think we're going to open it up a little bit for a sort of free-flowing discussion. And I think it's safe to say, everyone has, mentioned the turbulent waters that we're facing, developers are facing. But what would each of you, as the panelists, what would you like to share with the audience to encourage them to continue on in this market? Ben, do you want to lead us
Yeah,
off?
sure. I can take that one. I mean, as I mentioned, I mean the it's not as if deals are hard to get done in the supply demand imbalances because there's a lack of investor interest. There is investor interest. Deals are getting done. We're putting more affordable units out now than we almost ever have. I think a couple of points of optimism is that at the national, state, and local level, there is significant attention on affordable housing, and people are committed to finding ways to get it done. The House and the Senate at the federal level have competing housing bills in an effort to cut red tape, to streamline environmental review processes, to do several things to lower cost and streamline housing, whether it's zoning, whether it's other types of approvals needed, Davis-Bacon reform. Now they're competing proposals, and because of the lack of bipartisanship in Washington, I think they're just kind of beating each other up back and forth. So it has bipartisan support, but it's like between the House and the Senate, it's just kind of a funny process. So we're hopeful there. You know, on top of that, there are other ways that the state of Michigan, where I sit, they're proposing a state housing tax credit that they plan to have approved, and they have support for approval by the beginning of 2027. So that would be a way to fill gaps. And work, I would just encourage folks to work with your syndicator or investor and your lenders early on. A lot of what we run across is like, if there's an RFP or somebody needs an answer, can you do this deal? And you have a 4 week, 3 or 4 week deadline. It's very hard in this market for us to be able to commit to something like that. But what we can do is work with people and say, what's the timing? It might not be the timing you want, but what's the timing that you need? Because if our spring fund is full, can we work on a placement in the fall fund? If that's not a fit, what's the timing? How can we arrange this? Because sometimes that might be it. It might just be not now because we don't have room, but work closely, and there could still be placement. And as Caitlin mentioned, all the things, the REO schedule, financials, all those things, have those ready to go. You definitely will be asked about it. The quicker you can provide those and have them clean, shows you're on top of things and can move you up in the list, for potential placement. So I think those are, some specifics of things to think about. I think as the AHIC underwriting guidelines, there's more financial capacity that's required. Look at partnering with groups that have more experience. I mean, that's a way to kind of to work together to get things done. So I do think there's definitely still a path to get deals done. It's talk to folks early, have things clean, and work close together to get it to the finish line.
Okay. And Caitlin, do you want to weigh in on how to
Yeah.
overcome some of the turbulent waters that we're facing right now?
Yeah, no, I'll pile on to what Ben shared. I think it's worth mentioning, as he alluded to, both the House and Senate bills that are gaining attention. One of the provisions within those bills is a change to the public welfare investment cap that would allow for that to increase from presently 15% to 20%, which should allow for more investor capital to be deployed Similarly, we are seeing, or you may know that the solar tax credit market kind of was competed with the LIHTC market over the last few years. And as those provisions are also going to be phasing out in the next year or two, we suspect that the capital that was devoted to the solar market will hopefully be able to be diverted back to the LIHTC market. And also notable, Leah spoke to the Fannie Freddie side on the debt execution, but it is known that Fannie and Freddie are intending to deploy more dollars into the LIHTC market on the investment side. So I would say those points are worth noting as well. And from a positive perspective, even though the market is hard and getting through these underwriting challenges, take us a lot of time and energy. What I hope is an outcome of this year is that when the tide eventually turns and the markets start to balance and recalibrate, that there's a universal understanding of how to present the best opportunities to our investors and how to move a deal quickly because you've operated in an environment that was slow and difficult. And so take these opportunities, see these as opportunities to just refine your internal processes. For developers, one thing I've noticed on the REO side is that they may not have had the most advanced technology or reporting systems to allow them to provide up-to-date information on the status of their portfolio. What I hope comes out of the market today is that developers, property managers can invest in infrastructure that will allow that to be an easier reporting system. Because I truly do think that there's a lot of sponsors that have a portfolio that can speak very, kindly of their performance, but it just takes too long to pull that information. So my hope is that the aid of technology will make our work easier, and that this period of time, will allow us all to refine our crafts and be better able to process higher volume in the years ahead.
Okay, thanks, Caitlin. And Mark, do you want to weigh in a little bit about why we should continue to be optimistic?
Yeah, absolutely. I would, if I'd give any advice to people, I'd say proceed with caution, but still proceed. Our default rate is very low. It's very low right now. So you come to us with a loan and we're going to make it work. We see delays coming to the closing table. But we're on the same team. We want to make this work. Our missions align. And so if a developer needs more time, we're going to give them more time. There may be extension fees or interest rate adjustments, but we usually see these deals get done, even in very tough environments. The loans that we see don't work are the ones with developers who aren't communicating to us. They usually know that there's trouble in the waters, but they aren't sharing that with us, and so we can't be part of the solution. As a CDFI, we are committed to helping out where we can, giving some technical assistance for those who are feeling lost with a certain situation. And so we've been able to get some people out of some really sticky situations because of the way that we've been able to work with them. So I would say keep going, keep proceeding, and we'll make it happen.
Okay, and Leah, do you have anything to add here on why there's reasons to keep our heads up?
Yeah, 2 points I want to make about the market outlook is the first being that 30-day average SOFR is currently floating around 3.64% versus the 10-year Treasury, which is currently, I believe, at 4.45 and rising. Floating rate loans are becoming much more attractive and could be a good option to consider. The second point being that Fannie and Freddie are quoting longer forward periods in general to account for potential construction delays. they would prefer to quote a longer forward period up front than deal with an extension on the back end. However, we are a solution driven model, so we can accommodate either situation. But Fannie has updated their standard forward period to now 36 months. They do offer shorter forward periods, but less than 36 months is considered a credit exception. And Freddie's standard forward terms have changed from this time last year, they were quoting mostly 24 and 30-month forwards to now they're quoting 36 and 42-month forward periods, and even up to 48-month forward periods as their standard forward terms. So something to consider when you structure your loans. It's cheaper to get the longer forward period up front than it is to pay for the extension on the back end.
Okay. Well, we're going to move to the question and answer section of our webinar today. We're starting to get some questions to come in here. And Ben, I think you'll probably be the best person to respond to this one. I will read it verbatim here. You mentioned investor yield demands and underwriting expectations. Are you seeing investors move to other credit types or tax saving methods that are competing with LIHTC? If so, what's your opinion on why they are moving in that direction?
Yeah, for the last few years, solar credits have competed with low-income housing tax credits. And even though those are scheduled to phase out over the next couple of years, they're still in the market. Right now, the solar credits are a 1 year payback. A couple of things there. It's 1 year payback instead of a 10-year credit period like LIHTC has. Um, in a lot of ways, it's simpler. The solar field is built, or solar on top of a structure is built, and the credits are available. There's less compliance, less things to get through, and we know that the yields for solar range like 12 to 15%. So, you know, economic yields for low-income housing tax credits are closer to like 9%. So this is where, now it's creeping up higher than 9% because we are competing with solar. There are some large investors that have competing interests internally on that, they're looking for a return on their dollar, and they have, a tax department that does look to solar credits. So I think that has been, in the past, a point of competition. Now, also at the conference I was just at when we were talking about this, it's the amount of solar credits that are really being bought compared to LIHTC doesn't really necessarily move the needle as much as the oversupply of deals does. So I think it's contributing to it, but overall, they are phasing out. It's unknown what that looks like while they're phasing out now. Um, it's possible a new administration brings them back, so it may not be phased out for long. So there's a lot of unknowns for that. I think regardless, it's not going to be, the phase out of that will not quickly impact LIHTC pricing in the short term.
Okay. Leah, I think the next question here might be well suited for you, and I may weigh in on this one myself too. Regarding the GSE forward committed perm loans for 4% LIHTC projects, are there any recent trends you are seeing on uh, Freddie Tel versus Fannie MTEBs? Specifically, which execution seems to yield more proceeds? We know that interest rates on MTEBs deals are generally significantly lower than TEL deals right now. But with NEGARB and other MTEBs cost, where are you seeing things shake out? Well, all right. Leah, do you want to weigh in on that?
Yeah, I can start and then you can add any color you want. It's a great question. I think it's very specific to where the deal is located, what market the deal is in, and whether or not Fannie Mae will approve 40-year amortization. So if it's a repeat sponsor in a standard in Fannie's classified standard market, and you can get that 40-year AM approved, the MTEB will likely shake out to be better proceeds because of the rates. But if for example, the state of Michigan, majority of those markets are considered pre-review, and we've had challenges getting 40-year amortization approved. And so when they scale it back to 35-year amortization, it really impacts loan proceeds, making TELs the better option. So I would say that is the biggest factor right now. But on every deal that's a 4% LIHTC forward or immediate, we are going to both Fannie and Freddie, just given the current market and things consistently changing so quickly these days.
Yeah, thank you, Leah. And just a little more detail along those lines. What we like to do at Cinnaire, particularly on 4% deals, is give the borrower a side by side, apples to apples comparison of our 4% programs, Fannie, Freddie, and FHA. And as Leah mentioned, every deal is a little bit different, and so we like to lay those out for the borrower, go through those different options, and we're really agnostic as to what program is best, and it depends. So let's see, a few other questions here. Let's see, Caitlin, actually two questions. Another acronym, AHAC. What does that stand for?
An AHAP or AHIC? Just want to be certain.
AHAC, the underwriting
Oh
standards.
yeah, yep. That is the Affordable Housing Investors Council. So it's a group of representatives who work within the industry and work together to produce what are our underwriting guidelines, as well as a handful of other resources, materials, risk rating guidelines for asset management and related materials.
Okay, great. Thank you for clearing that
Mhm.
up. And Caitlin, sticking with you, can you give us an example, at least in general terms, of a somewhat turbulent deal and how we navigated that and dealt with it?
Yeah, I'll speak generally. Every deal these days has its challenges. And so what I kind of have a guide in my mind every time a deal comes to me with challenges. And I would say one fortunate thing is we're heading into the month of May. And so we do have new rent limits that have been released or income limits that have been released. So I would say at this point in the year, one of the methods we always look to is just making sure that we are reasonably but maximizing the amount of reasonable rents that can be collected. And related to that is also ensuring that there are no other sources that can be maximized to our benefit. Projects that have seller notes, where there is a seller, the person owns the property, is selling it to the partnership. They'll be recognizing sale proceeds from the sale to the partnership. I find that those are often the best deals that are able to absorb unexpected changes because those proceeds are able to hit the balance sheet of that partner right away and they can redeploy those funds back into the deal to allow projects to, like I said, buffer any changes in uses over time. Similarly, I've had a handful of projects where early into underwriting, we determined that we should bake in extra reserves. And worst case, if we later determine that they're unnecessary, they can help reduce or offset other costs. And on at least one of my projects, that is indeed what happened is we planned for the worst. We learned later on that we could shave some expenses here. We were able to gain more rent potential there, and ultimately we're able to scale reserves to an appropriate amount and offset some other costs. I would say those are the rent expense side is one piece of it. Also recognizing that for LIHTC investors, losses are an important part of the puzzle as well. And so really being able to design a deal that maximizes losses as well. So for projects that might look like increasing the interest rates on soft loans or related party loans just to generate additional losses and allow a deal to either maintain its pricing or to get some relief in the pricing regard. And lastly, I'll just speak to in today's market, if your project has an economic investor, then the yields that economic investors are asking for are surpassing what we're seeing for interest rates. So we've become a little more strategic with how much equity we deploy early on, and rather have equity bridge loan or construction loan proceeds come in sooner because the spread on the interest for the construction debt is less than the spread for the equity. And so, therefore, it is advantageous to the partner to have debt used in lieu of equity at the time of closing through stabilization. So, those are some of the, mechanics or strategies that we've had to deploy in today's market just to get some of these deals across the finish line.
Uh, okay, thank you. Thanks, Caitlin. Mark, I think this next one might be best suited for you. What qualities of a borrower do you appreciate the most?
Yeah, absolutely. I think I mentioned before, communication is huge. I will work all day with a partner who is willing to pick up the phone or, shoot back a quick email explaining what's going on. I appreciate the responsiveness. It's a good way for us to stay on top of the risk and make sure that we're getting what we need out of the loan. I'd say one who knows their loan documents. Uh, when you go to the underwriting table with your lender, understand those loan documents, read them, make sure they're terms that you can work with. Um, our underwriters are very happy to walk through that with you and help you understand the implications of all of those. That's very helpful on the portfolio management end because we have a better understanding of what the expectations are. So I'd say those are two things. Organization is also a key aspect. With the loans that we do draws on, it's great to have a draw package that is well put together, that's easy to navigate. We know exactly what you're asking for and why you're asking for it and when you want it. Um, that streamlines our process quite a bit. Most of my time is spent going back to the borrowers and getting clarification on draw packages that don't have quite enough detail. I'm very good at whittling out the details I don't need in order to approve it. So the more you send, the better. So.
Okay, good advice. And Leah, I think this one is best suited for you. What are the turnaround times these days at the agencies Freddie and Fannie?
Yeah, good question. So Fannie typically takes longer up front to get to quote because they go through the weeds a lot more on the front end. So their average turn times to quote from the quote submission to get an actual quote is about 3 to 4 weeks on average. And they are faster on the back end. So they can be as quick as 2 weeks from the time we submit the underwriting package to the time we can issue a draft commitment. Freddie, on the other hand, is the opposite. Their average turnaround time from quote submission or quote request to quote is about 2 weeks, with it can be longer if depending on the complexity of the deal. And their timing right now from underwriting submission to draft commitment is about 3 weeks, which has been reduced recently. Previously, it was 4 weeks. So.
Okay, thank you for the detail on that, Leah. Last call for any questions from the audience. And I would just like to thank everybody for participating today. And if you have any follow-up questions that you want to deal with offline, feel free to contact any of the panelists here. We'll be happy, obviously, to address those. We want to be your trusted advisor. And as I mentioned at the start of the webinar, Since this webinar was recorded, we will send out a link to everybody who registered today, so that they can go back and review the webinar or share it with somebody else. So I think I guess that wraps up all the questions that we had. Thank you again. We'll be doing more webinars in the future, and we look forward to seeing you again. Thanks.